Today, Bluster or beef, the there and back again market crash. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. This is our weekly market update, where we start in the US, across to Europe and Asia, and end in Australia, covering crypto and commodities along the way. It's been another momentous week on the markets. Having fallen hard in reaction to Trump's Liberation Day tariffs, they've now clawed back most of those losses, helped by strong economic data and potential easing of trade tensions between the US and China, and a general watering down of tariffs from the US. The tit-for-tat tariffs between the world's two largest economies have kept investors on edge, with both sides seemingly unwilling to be seen to be backing down. But the negotiation process is likely to take months, if not longer, as China said on Friday that it was assessing the possibility of trade talks with the US, and they urged officials in Washington to, quote, show sincerity. Investors are turning their focus to potential winners from the New World Order fashioned by Trump as markets return to some sort of semblance of calm. Should the odds of a US recession grow, the pivot away from US equities and dollar-based assets may well continue, as markets seem to have swung to believing that US President Donald Trump is backing away from his more belligerent tariff threats, and that a more receptive Washington is closing in on several bilateral trade deals. April the 30th marked the first 100 days of Trump's second term. So the question is Trump more bluster than beef? Well, we'll see. The global MSCI index is now 0.94% higher year to date, following a significant drop and then an 11% rise over the past month. The stock 600 in Europe has risen more than 8% over the past month, following its earlier fall to be 5.68% higher year to date. And the UK FTSE 100 capped off its longest winning streak on record with a 15th consecutive daily increase. That's the longest run of positive days in a row in history for the British benchmark index, while the Australian ASX 200 closed a 2-month high on Friday. Equity benchmarks in India, Mexico, Brazil and South Korea have all recouped their losses since the tariff shock and are among the best performers globally. And Chinese and Hong Kong stocks have stumbled, though, as a standoff between Washington and Beijing continues. US markets rallied on Friday, with the Dow up 1.39%, though it's still down 2.88% year to date, while the S&P 500 rose 1.47% to be 4.63% lower from January the 1st, and the Nasdaq rose 1.51% on Friday, but is still down 6.9% year to date. The VIX was down 7.8% on Friday to 22.68, though still 30.7% up year to date, and it shows that fear has not altogether gone away. On the corporate front, dozens of leading global firms cut or declined to give forecasts in their first quarter earnings. Such is the uncertainty surrounding tariffs, yet the overall tone from those calls this week was positive, and investors have consistently bought the post-Liberation Day dip. The US economy added 177,000 jobs in April, which exceeded expectations. The unemployment rate held steady at 4.2%. The data helped to assuage concerns of an economic slowdown following the Commerce Department report, showing a contraction in US gross domestic product for the first time in 3 years, weighed down, of course, by tariff-induced floods of imports, suggesting that it was a statistical anomaly. And that's also putting the economy halfway towards a technical recession. Apple fell nearly 4% after the iPhone maker trimmed its share buyback program by $10 billion, and CEO Tim Cook told analysts that tariffs could add around $900 million in cost this quarter. Other so-called Magnificent Seven stocks, such as Amazon, Meta and Nvidia, were trading up between 0.3 and 5.2%. And year to date, by the way, Microsoft stocks are up 4.4%, while Amazon stocks are down by 14%. That tells you something. Oil giant Chevron rose 1.6%, while ExxonMobil added 0.5% after both reported quarterly results. But Block slumped 21% after cutting its profit forecast for 2025 and missing estimates for quarterly earnings. The risk to growth and markets lay ahead, and a cliff edge type of adjustment in the coming months is certainly possible. There appears to be similarities to the Roadrunner cartoon in which Wile E. Coyote keeps on running long after the ground has disappeared beneath his feet, ahead of the inevitable moment of realization when gravity kicks in, according to one analyst. With consumer sentiment sliding and inflation expectations rising, stagflation looms. For markets, that suggests choppy waters ahead rather than plain sailing. And just remember, the S&P 500 is now trading at 21 times the projected earnings growth rate of 9% in 2025. That is an extremely rich multiple on a very optimistic earnings growth rate, given the fact that US GDP shrank during Q1. And that shrinkage will soon be combined with significant margin pressure from the tariff chaos that began at the start of Q2. You simply cannot get earnings growth when both profit margins and the economy are contracting. Not only this, but a parade of companies are now pulling away revenue and earnings guidance for the second quarter, which is a very rare occurrence indeed. Well, the stock market has already priced in the imminent removal of all tariffs and the Fed's put being deployed, think low interest rates and QE, and has also priced in the seamless and harmless extension of the Trump 1.0 tax cuts, which are set to expire at the end of this year. What is not at all priced in is the empty shelves and a surge in prices which lays around the corner. By the middle of May, thousands of US companies will need to replenish inventory. Big box retailers like Walmart and Target told President Trump in a meeting last week that shoppers will likely see empty shelves and higher prices very soon. Economists are warning of COVID-like shortages and significant layoffs in industries spanning trucking, logistics, and retail. This is not theory or conjecture. Since the US raised levies on China to 145% in early April, cargo shipments have plummeted by 65%. Ramifications of this tax shock are now unavoidable. Data released by the US Department of Agriculture revealed last week that China made its biggest cancellation of pork orders since 2020, halting a shipment of around 12,000 tons. And in addition, inflation has become the salient issue for the US consumer, especially for those in the bottom 4 quintiles. For instance, 11.1% of all credit card holders can now only make the minimum down payments on their outstanding balances. This is the largest percentage on record in the 12-year history of the data series. A LendingTree survey found 25% of buy now, pay later users fund grocery purchases for this type of loan. This is an increase from 14% in 2024. And also 41% of survey respondents said that they made a late payment on a buy now, pay later loan in the past year, up from 34% last year. The Federal Reserve's preferred inflation measure, known as the Personal Consumption Expenditures Price Index, sharply increased by 3.6% in Q1, up from 2.4% in Q4 last year. So all up, a retest of April's lows does remain a likely scenario. In currencies, Trump's policy whiplash has driven investors to havens such as the Swiss franc, which has strengthened more than 6% versus the greenback since April the 2nd. The euro and the UK pound have also fared well, although sterling was flat against the dollar and fell 0.3% on the week. That's the biggest weekly decline since February. The yen was 144.96, while the DXY was last at 99.99. The bond market is sending a signal that the Federal Reserve should be cutting interest rates, according to US Treasury Secretary Scott Bessent, noting that yields on the 2-year Treasury note were lower than the central bank's policy rate at 3.826, while the 10-year was at 4.31. The spread between the Fed rate and 2-year yields, a bond market proxy for expectations for where monetary policy is headed, has widened persistently over the past 2 months. That has come as fixed income investors in both treasuries and interest rate futures have pivoted to bets the Fed will cut rates by a full percentage point this year, double the most recent median estimate among Fed policymakers themselves, as the economy weakens in the face of Trump's tariff onslaught. But I have my doubts about what the Fed will do, given that inflation is not yet slayed. But that said, borrowing costs such as residential mortgages have dropped in the US by about half a percentage point since the Friday before Trump's inauguration in January, although bond markets have been particularly volatile over the past month due to the president's erratic implementation of tariffs. The rate on the 30-year fixed mortgage is about 6.81% on average last week, after climbing abruptly by around 20 basis points in the middle of April on the heels of the bond market ructions. Gold has come off recent highs at $3,247 an ounce, but is still up more than 40% over the past year. The gold price has been driven by multiple factors, including the spectre of a trade war, geopolitical turmoil in the Middle East and Ukraine, stock market volatility, and dollar weakness. According to the World Gold Council, every market except China reported value growth, suggesting that consumers were prepared to stretch their budgets in the light of higher prices. Central bank net gold purchases came in at 244 tons, which was 21% lower than the first quarter of 2024, but as the World Gold Council puts it, comfortably within the quarterly range of the last 3 years. Oil prices were down again on Friday as the commodity approaches the end of a difficult week, despite hopes of a scaling back in the bitter trade war between China and the US, the two largest economies in the world. Brent crude briefly fell below $60 a barrel on May the 1st, nearly revisiting April's lows after headlines suggested that Saudi Arabia would be willing to raise output and let prices slide further. It was last at 61.45, while WTI was last at 58.41. OPEC Plus heads into its May 5th meeting with oil prices under renewed pressure and member countries divided over whether to accelerate production increases, leaving oil prices poised to swing lower, or a short covering rally, depending on the group's decision. That's according to Citi analysts. In Europe, following Thursday's May Day holiday, most markets were higher on Friday. The DAX index in Germany closed 2.6% higher. The CAC 40 in France gained 2.3%, and the FTSE in London rose 1.1%, all in reaction to the prospect of trade talks between the US and China. NatWest Group returned to profit in the first quarter of 2025, posting $59 million in earnings as income rose across all major business lines and costs declined. The increase was driven by higher revenue on fixed income, currencies, and capital markets, along with the recycling of foreign exchange reserves in the prior period. Income was partly offset by a lower contribution from the profit-sharing arrangement with other NatWest Group subsidiaries. By segment, capital markets generated $181 million in income, up from $164 million in the previous quarter. Shell stock rose 2% after the oil giant posted first quarter adjusted earnings of $5.6 billion, up more than 50% from the previous quarter, driven by stronger results in its integrated gas and upstream businesses. European economic data, though, disappointed. While Eurozone headline inflation held steady at 2.2% in April, in line with market expectations, core inflation, which excludes food and energy prices, rose from 2.4% to 2.7%. This increase was driven entirely by a jump in services inflation, which climbed from 3.5% to 3.9%. Another survey showed that Germany's manufacturing sector contracted at the slowest rate in more than 2.5 years in April, with the HCOB German manufacturing PMI rising to 48.4 in April from 48.3 in March. The French manufacturing sector posted its first rise in output in nearly 3 years in April, with the HCOB final French manufacturing PMI rising to 48.7 in April from 48.5 in March, marking its highest level since January 2023. Most Asian stock markets rose sharply on Friday, tracking overnight gains on Wall Street, with Hong Kong leading the rally after China said that it was considering potential trade talks with the US. With mainland China exchanges closed for a public holiday, Hong Kong-listed Chinese equities led gains. China's Commerce Ministry noted that Washington had sent signals through various channels seeking to start talks. China added that if the US wanted to talk, it must show sincerity and cancel the unilateral tariffs. Hong Kong's Hang Seng Index surged 1.8% on Friday, with Chinese heavyweights such as Alibaba and Xiaomi Corp jumping 4.2% and 5.4% respectively. Japan's Nikkei 225 rose 1.2%, while the broader Topix index gained 0.3%. The Bank of Japan held interest rates steady at 0.5% a day earlier and reduced its economic forecast, lowering growth projections for real GDP and inflation. For fiscal year 2025, the real GDP growth is now expected at 0.5%, down from 1.1%. And elsewhere, South Korea's Kospi added 0.4%, while India's Nifty 50 closed higher, despite ongoing geopolitical tensions with Pakistan. In Australia, data on Thursday showed that Australia's trade balance grew sharply above expectations in March as exports jumped ahead of expected US tariff announcements, while retail sales were flattered by high migration but were anemic when adjusted per capita. A day earlier, data showed that underlying inflation fell back into the Reserve Bank of Australia's target range of 2 to 3%, just supporting the case for a rate cut. The door is clearly open for a rate cut from the RBA in May, according to ING. All eyes now will be on the election result due later today, with Labour tipped to return for another 3 years after, frankly, a lacklustre performance from both major parties. But the Australian share market closes a 2-month high on Friday after China said that it was considering those trade talks with the US, boosting hopes that tariffs will be eased. The ASX 200 jumped 1.1% to 8,238 at the closing bell. That's the 7th consecutive day of gains. The index notched a weekly gain of 3.4%. The All Ords rose 1.1% on Friday. The news from China, the world's largest importer of crude, fueled a rally in energy stocks after oil prices reversed a 3-day losing streak. Woodside rose 2% to $20.61 and Santos added 2.7% to $6.08. Iron ore miners also recovered ground, with BHP up 0.7% to $38.08, but Singapore iron ore was last at $96. Banks and healthcare stocks buoyed the local share market, with CBA lifting 1.4% to close at 169.66, having briefly touched a fresh record of 169.75. Westpac added 1.9% to $33.45. In the healthcare sector, CSL was up 2.1% to $256.41, while Sigma Healthcare jumped 3% to $3.10 after Morgan Stanley initiated coverage on the stock with an overweight rating. Technology stocks rallied as investors shrugged off a gloomy earnings outlook from Amazon and Apple. WiseTech Global advanced 0.7% to $95 after confirming Street Talks report that it was mulling the acquisition of New York-listed supply chain platform provider E2Open. Corporate travel management slumped 10% to $11.70. The travel management company said it expects to report lower revenue and earnings growth due to the impact of tariffs on client demand. Block, however, extended its decline from Thursday and sank 26.7% to $67.50 after the digital payments provider lowered its full-year profit guidance. And Capstone Copper jumped 2.8% to $7.84 after the copper miner hit record revenues of $533.8 million in the March quarter. Finally, in crypto, Michael Saylor, the renowned Bitcoin advocate and the executive chairman of BTC-focused company Strategy, has taken to his official social media account to make a bullish Bitcoin statement again, while the world's flagship cryptocurrency is striving to recapture the $97,000 price mark. This time in his tweet, Saylor metaphorically likened Bitcoin to other assets on the market, stressing Bitcoin's dominance and resilience compared to other investment tools. Bitcoin is currently at 96,327. Earlier this week, old-school commodity trader Peter Brandt published a tweet sharing a bullish Bitcoin price prediction. The trader believes that by the end of this year, the world's leading cryptocurrency may reach 125,000 to 150,000 US. Well, we'll see about that. And finally, Michael Ellis, the Deputy Director of the Central Intelligence Agency, was recently appearing on Anthony Pompiello's The Pomp podcast to discuss, among other things, cryptocurrencies and Bitcoin in particular. Ellis stated that Bitcoin is, quote, here to stay, while highlighting Bitcoin's growing institutional adoption, which he thinks is a great trend. The Deputy Director sees Bitcoin as part of global technological competition and believes that it is important for the US to stay ahead of China in the crypto arena. Ellis also pointed out the tremendous potential of using crypto for tracking what US adversaries are doing and to disrupt them. The discussion around the CIA's involvement in crypto has been fueled by past events, including a visit from Bitcoin developer Gavin Andresen to the agency in 2011, which some believe may be connected to Satoshi Nakamoto's subsequent disappearance. And of course, some think Bitcoin is a CIA plot. Anyway, this lack of grounded analysis of Bitcoin and the overall market should be taken as a warning sign. There are risks across markets, and the trends up and to the right are not likely to be linear. More than ever, an air of caution remains appropriate. Just remember, 21 times PE is big, and it means that if beef is in the Trump tariffs, then markets are overpriced. But if it's bluster, as the markets are thinking, then even so, well, markets are still expensive. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.